Something massive just broke in China and sending shockwaves worldwide. I'm Steve Van Metre. Imports are crashing, demand is plunging, and what's coming for the global labor market is outright terrifying. Plus, we have a sponsor for today's show. I'd like to welcome Wearable Devices. You can find them on the NASDAQ under symbol WLDS, and they develop a non-invasive neural input interface for controlling digital devices using subtle finger movements. And for the technical traders, their stock is rallying off a double bottom, setting up a potential 25% move higher. This is one you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to CNBC, where we find out what started in China is rapidly spreading across Asia and now even starting to hit right here at home. As the trade war fallout is here, cancellations of Chinese freight ships begin as bookings plummet, and we warned that this was going to happen. We were already facing a payback period from the pandemic and front-running the tariffs, and now what we're seeing, because the trade war continues, that there's a massive plunge in demand. It started in China, is quickly spreading across Asia, and is now starting to impact us right here at home. But the problem is, this is only the beginning of what is to come. A total of 80 blank or canceled sailings out of China have been recorded by freight company HLS. As we see demand plummeting, now carriers are starting to suspend or adjust trans-Pacific services. Even Major Ocean Freight Alliance 1 has, quote, suspended until further notice, a route it had previously been planning to bring back in May. So just as we started to see a continued sign of the global economy emerging from the pandemic, what we're now finding out is the trade war is completely reversing that in a way that nobody expected. And what it's going to do is drive the global economy right into a recession, perhaps much faster than anybody thinks. And the impact of the diminished freight container traffic to North America will be significant for many links in the economy and supply chain, including the ports and logistics companies that move the freight. And what we're seeing is this decline could lead to a decrease in crane operators at the ports, lower fees that could be collected, and declines in container pickups and transports by trucks, rails, and to warehouses for storage. Even the World Trade Organization weighed in on Wednesday that the outlook for global trade has, quote, deteriorated sharply. And this is a major problem, because what we're seeing across the world is workers need jobs. They need their incomes to grow. They need more hours to keep up with inflation. And now what we're seeing, based on this massive deterioration in global trade, is it's going to have a huge impact on the labor market all across the world. And the evidence is very clear as we look at it. Imports of goods and services, this in blue, coming into the United States on a year-over-year rate of change against the unemployment rate in red. And I want you to see just how important that global trade is to economies, as we can go back to the late 1980s. And what do we see? Imports into the United States were decelerating, and at first it didn't impact the economy because it was still running at a fairly strong clip. But look what happens as global trade slows. We see the unemployment rate bottoms and starts to head higher, and what happens? Imports enter a contraction. We go right into the 91 recession. Let's move forward to the dot-com bubble, where we see a surge higher in imports, and they roll over and head down. And look at how quickly it hits the labor market and pushes us right into the dot-com bubble. We see the same thing going in global financial crisis. Imports are rising, but the problem is the underlying economy was already weak. You see that imports nosedive, and that puts a lot of people on the unemployment line. But this doesn't always cause a recession, as we can see between 2013 and 2016. We note that imports went negative, but the labor market was strong enough to create jobs. But right now, it doesn't appear that's the case, as we see that contraction around 2023 in imports put a bottom in the unemployment rate. We see unemployment rate has steadily, slowly ticked higher, but now with the threat that imports are going to crash and go deeply negative, it means a lot of workers, not just here in the United States, but all over the world, are going to hit the unemployment line. And China accounts for approximately 30% of all U.S. containerized imports. This is now down from 30% in 2018, but accounts for approximately 54% of all U.S. containerized imports from Asia, down from 67% in 2018. So as we see a crash in demand here from China, what it means is going to backflow all across the supply chain, all across the labor market, is going to put a lot of people on the unemployment line. But just because the economy is tanking doesn't mean your trading account has to go down with it. Let's take a look at the chart from Wearable Devices. Again, you can find them on the NASDAQ under symbol WLDS. And check out this double bottom. You can see the first one formed right here, and the stock rallied off of that, pulled back into support, formed the double bottom, and is taking off from there. And we think that this could rally another 25% up to $2.80. Stay tuned to the end of the show, or check out the pinned comment or description for more information, because the Director of Global Logistics and Future Mobility for Stifel said the tariff policy has created significant uncertainty with respect to consumer demand, and retailers have been positioning their businesses conservatively with inventory, especially given the quote scar tissue from the recent overstock after the post-COVID supply chain squeeze between 2021 and 2022. But it's really about consumer demand here. What is the issue consumers are facing? Well, here in the US, massive amounts of debt at high interest rates, but that's only part of the problem, because when we look at their jobs, well, there's a lot of uncertainty that we've seen in the recent Conference Board and University of Michigan sentiment surveys, suggesting that workers are worried about their finances, they're worried about their jobs, and they're worried if they lose their jobs that they're going to be unable to find another one. And this is showing right up in the income statistics, where we see hourly wages are decreasing slowly and hours worked are trending down, meaning paychecks are shrinking. So we know that the problem here that everybody is facing is consumer demand is plunging, has nothing to do with the tariffs, but has everything to do with incomes and the fact that prices are going to shoot higher. And that uncertainty is beginning to manifest in blanketed container ship sailings on core eastbound trans-Pacific lanes, opening the potential for double-digit decline in inbound containerized imports as soon as next month. So we're facing this hitting us in the very near-term future, and when it hits, you're going to watch a lot of companies are going to cut hours, and then they're going to cut jobs. They're going to have absolutely no choice, because we're going to see demand outright crash, because again, consumers are struggling under the weight of inflation. And now we're about to see where prices are going to go. Because when we take a look at the consumer price index in blue against real retail sales in red, both shown on a year-over-year rate of change, we can see the effect of what happens when prices surge higher, when consumers can't afford it. You can see that real retail sales peaked, rolled over, and decelerated until it entered a contraction right in line with the dot-com bubble. We can see consumer prices surged higher due to rising energy costs going into the global financial crisis. This forced consumers to cut back on the discretionary spending. It hit retail sales that spent a few years being negative before they rolled over into a steep contraction, signaling the global financial crisis was on. And look where we're at now, going back to 2021, as pandemic stimulus dried up. We can see that, of course, as inflation surged higher, retail sales crashed. They've remained largely at zero over the past 3 years. And right now, with the threat of inflation going higher as soon as next month, we know the direction for retail sales is likely negative, but this is also an issue of inventories, and we made this case that due to the front running of the tariffs, we're facing an inventory recession. And this was something that wasn't in the cards coming out of the pandemic, but now all of a sudden it's a very real issue that could lead to a massive amount of disinflation and potentially all-out deflation. Let's take a look at retailer inventories in blue against real retail sales, still shown in red. Let's go back to the late 1990s, and what do we see? Retail sales peak and roll over. At the same time, inventory levels were growing at a steady 6% clip. And at one point, retailers said, look, we have too much inventory. So what happens? They stop ordering, and this flows back into the wholesaling level, into the manufacturing level. And what do you see? Across the board, hours get cut, and then jobs get cut as demand goes down. We see that happen again going into the global financial crisis, as retail sales went to zero for the most part before they turned negative. But look at retailer inventories. They were growing somewhere around a 3 to 4% rate. And we can see here recently that retailer inventories were growing at a 6% annualized rate. And while that slowed a bit, we can look back at real retail sales and say that they've been really largely zero for the past 3 years, meaning inventory levels clearly too high. And now what we're seeing is a massive payback period that's going to start as soon as next month. And for a lot of people that are struggling with the weight of inflation, this is the worst possible news, because they can already see their hours getting cut, and next thing you know, their job is going to get cut with no opportunity to re-enter the workforce. And the numbers, my friends, are staggering. As booking volumes for last week of March to the first week of April across global and U.S. trade lanes outright plummeted. There were sharp decreases in bookings across several categories, including apparel and accessories, wool fabrics, and textiles, both down over 50%. Major product categories from China that are moved in containers include apparel, toys, furniture, and sports equipment, all of which are now subject to steep tariffs. And look at this. Overall U.S. imports plunging 64%. This is staggering. Overall exports out of the U.S. down 30%. Imports from China down 64%, and exports to China down 36%. This is not just going to hurt the Chinese economy. It's going to have a devastating effect on the U.S. economy as well. I know a lot of people say, well, we don't export that much to China. We don't have to export much because those that are involved in that kind of trade and transportation are they're going to be the ones that lose their job. And when their spending decreases, it's going to backfeed all across the U.S. economy. But it's not just a Chinese issue. A shrinking Korea export sent global warning on Trump tariffs that with payback period is starting next month. And one of the world's first trade figures for April to come out after Trump ratcheted up his tariff campaign, the value of South Korean shipments adjusted for working day differences fell a whopping 5.2% from a year earlier in just the first 20 days of April. It showed outbound shipments to the U.S. and China were down 14.3% and 3.4% respectively, while exports to the European Union and Taiwan were up 13.8% and 22%. So what we're seeing is demand in the U.S. plunging. We already knew that because consumers were cash strapped. At the same time, inventory levels were already very high. But China is very interesting here because they bring in imports to their manufacturing sector, build things, and export it. So what we're seeing by a big decline in imports to China is validating their economy, and the global economy are slowing as well. But it's also hitting Japan as Trump tariffs already hitting some Japanese firms, a recent survey showed. The auto company says orders have already been canceled and one firm has cut hours. There is the evidence for factory workers, while those in the tourism sector said they are concerned that a stronger yen would weigh on inbound visitors. So what we're seeing again, China spreading into South Korea, into Japan, and of course that means hours worked are getting cut, and it makes perfect sense because the global economy is powered by consumption, imports, and exports, and when you constrict that, well, bad things happen. And let's take a look at the imports of goods and services still shown in blue, now against the average weekly hours of production of non-supervisory employees. So again, at a time workers need more hours, they need to see their take-home pay increasing to deal with inflation. Exact opposite's about to happen. Here we can go back to the early 80s, and what do we see? A contraction in imports led to a cut in hours. We can see that happen again in 85. We see it happen going into the 91 recession as imports fall and hours work go right along with it. We can see it going into the dot-com bubble, the global financial crisis. You can see it happen around 2014, 2016, into the pandemic. And we've seen hours work get slashed as imports went negative, but we saw a recent surge that's had everything to do with front running of tariffs. But based on what we're seeing coming out of China, that's going to hit U.S. shores next month. That's going to be a huge decline in demand and shipping. This is going to reverberate again all across the supply chain. We're going to have too many workers. This means hours are getting cut. That's going to be the minimum. They're going to get slashed in a big way. Some people are going to be out of work. As Halliburton drops after reporting lowest sales since 2022. And remember, President Trump said he wanted oil prices to go down because he wanted gas prices to go down. Well, now the problem is because it's impacting the ability for companies like Halliburton to frack and drill, it means there's going to be a lot of oil workers out of work. And the dominant North American oil field service provider had the first quarter revenue of $5.4 billion, its lowest since 2022. And that meant its shares have fallen. And that means people are going to be out of work because we need to see a minimum price in oil to sustain the labor market. Now let's go back to the period as we headed into the dot-com bubble. What did we see? That oil prices rallied. That kept the labor market going. But as oil prices started to fall, there was an inflection point that meant oil field workers hit the unemployment line. And because prices were going down, there was no opportunity for them to get a job, meaning right into the recession. Now, going to the global financial crisis, the opposite happened. We saw a surge in oil prices, which was great for the energy sector, but terrible for everybody else because prices on energy meant a cut in discretionary spending right into the global financial crisis. But look at where we're at now. What Halliburton's saying is prices at their current level, well, they can't afford any new production. That means, of course, we're going to see hours work cut and jobs lost in the oil field, but it's also now showing up in the manufacturing and services sector as we turn to the Richmond Fed survey. As the 5th District manufacturing activity slowed further in April as the composite manufacturing index fell deeper into contraction. Of its 3 component indices, shipments and new orders fell notably and employment fell slightly. And the problem for the manufacturing sector is new orders is a lifeblood. If you have a lot of new orders, you can keep your workers busy. You can give them the hours you need to give them. If you don't, you have to rely on your backlogs. But the problem is when they're gone, well, so is your need for labor. And the future indices for shipments and new orders fell considerably, which makes perfect sense by what we're seeing out of China as a warning to the world. And here's the bigger issue. The backlog of orders index fell notably from -1 to -24, means backlogs are going away and fast. And once again, when they're gone, well, employees will be gone too. The average growth rate of prices paid increased notably. The average growth rate of prices received increased somewhat, meaning manufacturers were unable to pass along higher prices. What we're facing here is demand going down and an indication that the U.S. economy is headed right into stagflation. But it's also impacting the services sector as activity slowed in April. The revenues index fell as well as the demand index. Again, many people said the services sector would hold up, and we made the case. Where manufacturing goes, services does follow. The local business conditions index decreased considerably, and firms were less optimistic about future business conditions. Now, this will impact employees, but right now, at least in Richmond, the current employment index increased slightly as many firms expect to increase wages over the next 6 months. But average growth rate of prices paid decreased slightly due to competition. But get this, the average growth rate of prices received decreased modestly from March, again indicating an inability to pass on higher prices. What we're seeing here is the U.S. economy headed right into stagflation, which is why we saw this from Besant as he sees a de-escalation with China as the situation is unsustainable. The reality is the situation is unsustainable because starting in next month, the air pocket that we've been warning about, the air pocket from the pandemic, from front-running the tariffs, and from extending this trade war is going to hit, and it's going to hit hard. It's going to mean a lot of workers are going to see their hours cut. That's going to be the minimum. There's going to be a massive amount of jobs lost with no opportunity to re-enter the workforce. But one thing we are bullish on is that is the stock for our sponsor for today's show, wearable devices. You can find them on the NASDAQ under symbol WLDS. And as we showed you earlier, their stock has hit a technical double bottom and is rallying off that, one where we think their price could surge by as much as 25%. Stay tuned. We'll look at those charts again because, again, everything you need to know about wearable devices in the pinned comment and description below because they pioneer a non-invasive neural interface, turning subtle finger movements into seamless digital control. They're in the final stretch of manufacturing the Metre band, their first B2C product, an aftermarket Apple Watch band that brings touchless magic to your wrist. And wearable devices is transforming human-computer interaction with its AI-powered neural input technology for both consumer and business markets. Its innovative products like the Metre band and Metre Link allow for touch-free interaction by converting subtle movements into intuitive controls, enhancing experience in gaming, AR, VR, and XR. The company employs a dual-channel business model, offering direct-to-consumer sales and enterprise licensing while setting a new input standard for the extended reality market. And they've got the world's first neural wristband, which is rather impressive because they've announced the development of large MUAP models, a groundbreaking technology aimed at revolutionizing human-computer interaction by enabling personalized, intuitive gesture control through the decoding of neural data. This innovation has the potential to enhance users' experience with digital devices and integrated augmented reality platforms, paving the way for seamless interactions in the AI and XR era. They've recently introduced large MUAP models, a cutting-edge technology aimed at revolutionizing human-computer interaction through personalized gesture control powered by neural data. By decoding motor unit action potentials, LMMs are designed to create intuitive interactions with digital devices, positioning the company for advancements in the emerging fields of artificial intelligence and extended reality. And they're developing innovative AI-powered gesture control technology aimed at transforming user interactions by enabling personalized micro-gesture recognition through a neural wristband. The company is focused on creating a seamless, intuitive experience across extended reality devices that aim to collaborate with industry innovators to enhance accessibility and engagement in AI-driven environments. And they've also received a notice of allowance for a patent in the U.S. covering its innovative gesture and voice-controlled interface technology, which can measure physical properties like weight and torque using wearable devices. devices. The patent supports applications in aiding disabled individuals, boosting industrial productivity, and enhancing virtual reality experiences. This patent strengthens the company's intellectual property portfolios and integrates these advanced features into its products. In 2024, Relied Devices made significant strides in neural interface technology, launching products like the Metre and expanding collaborations with Qualcomm and Ray Neo to advance augmented reality and XR experiences. The company saw strong growth in revenue, increasing from $82,000 to $522,000, driven by sales of its near gesture control devices. Strategic partnerships, product innovations, and international IP filings position wearable devices for future growth in the expanding market for touchless, neuro-based wearable technology. And they've announced expansion of its large motor unit action potential model into new markets such as predictive health monitoring and cognitive analytics, enabling real-time physiological insights for healthcare and enterprise applications. The AI-driven biosignal platform, which analyzes muscle activity for gesture control, will now support early detection of health conditions and monitoring mental states, with plans to collaborate with businesses and researchers. This development aims to position the company as a leader in biosignal intelligence and neuro interface technology. Let's take a look at their stock here, because you can see on the 10-day chart it's set in a bottom here. There's a volume profile line, and the stock launched off of that, and that is the setup on the right side of this double bottom. You can see the price came down right into the supply zone here and rallied off of that. It pulled back, held that double bottom. Price is rallying off. We see it heading up to $2.80, which could realize a potential 25% return from right where it's at now. But again, you can find wearable devices on the NASDAQ under symbol WLDS. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.